Okay, Seth, welcome back, buddy.
Hi, good morning, Dale. How are you, sir?
Good, buddy. So, welcome back. And
Thank you.
interesting topic that you selected today, talking about volatility and the lack of. And, we've been talking about for quite some time. The VIX has been making higher lows despite new highs in the S&Ps for about a year when we were trading under 10, and they are higher lows.
Right.
And we're getting into an area where if the S&Ps make new highs and it's not a huge acceleration, it's really going to be a test for the VIX to see if it can hold this 14, 13 area or wash out. What are you thinking? And you can share your chart by just hovering your mouse over the menu, and you'll see a green box that says share. And there you go. Okay. So we
Yeah, I
got,
tend to look more closely with regards to your considerations on the VIX making higher lows. The way, there's various ways that you can look at a VIX chart. I tend to not favor looking at, a VIX chart simply because it doesn't work within my trading paradigm to, perform technical analysis on the VIX. And over the last 8-9 years that I've been trading the VIX complex, it's more or less a depiction for me. The extrapolation from a chart is simply a depiction of what I've already discerned from the macro outlook. And, the VIX is just telling me it's moving from one regime to the next. That's typically what the VIX does. We saw in 2017 all-time low on the VIX. We saw an all-time low median on the VIX as well at 11% for the year.
okay.
And then from that period, you go to the next volatility regime, which, was 2018, elevated, significantly above on the median and mode, the VIX above the 2017 level. So here in 2019, we're in another volatility regime, and volatility regimes can last anywhere from, 6 months to a full year. But we're in a calendar year where we're below, the volatility levels thus far on the median VIX that we were in 2018, and we're pretty consistent with regards to what you tend to see during an easing cycle. And I know it's kind of a faux pas right now to suggest this is a Fed easing cycle based on the language they prefer for us to use maybe. But that is, what we're seeing in the VIX is typical of what you do tend to see during an easing cycle, which is extended periods of complacency or relaxation, lower level readings on the VIX.
Seth, I've been asking a lot of people that have been coming in, our guests, what they believe is really happening in the repo market. I know that, you're a student of the market, and the explanation was, it's technical. At first they gave reasons like large corporate tax payments. I suspect that there might be other reasons why the banks would bid up funds in the overnight market, why they would, even with, like you're saying, the Fed's easing, why would they need to even scramble for overnight funds?
Yeah, I don't necessarily buy into some of the explanations that have been, fettered about
What do you
lately.
think it is?
I think there is serious considerations of what's going on in the corporate bond market. I think that there's a problem out there. I think the Fed has to, at this point, rationalize and kind of step in and expand their balance sheet and basically support what you. I mean, there's no other way to describe it, but when an event like that happens, there's obviously a crack in the foundation.
Well, doesn't that kind of fly in the face of the narrative that in the last financial crisis, the Great Recession, which wasn't great for anyone but the banks and people that bet on the short side of housing, that the banks had cleaned up their balance sheets here in the U.S. and we've been saying, see, we took care of things. There's no systemic risk, whereas Europe did not, and that's why Deutsche Bank and other banks are having problems.
Well, and I'm sorry to interrupt, but
Go ahead, it's
systemic
fine.
risk basically just moves from one aspect of the financial system to another, and it evolves through product. You know, we had the CDOs back during the mortgage meltdown, and now we have
it's corporate bonds.
Right, and leveraged loans.
Okay.
And I think these are kind of the newfangled CDOs, if you will, or, you know, a bubblicious type activity that's going on that is starting to rise to the surface. So I don't think we ever solve human behavior. You know, we don't necessarily correct the behavior. We don't, you know, we never took our medicine, so to speak. So we look for other areas to express the same human behavior within the financial markets, just in different assets and using different leverage or amounts of leverage. And I think that's basically what is surfacing in the here and now through the leverage loan market.
Okay. And what are leverage loans? Are they for possibly some of these unicorns that?
A good deal of them, yes. And a good deal of it is, you know, you can find in, you know, some of our more heavily indebted companies and those that are at risk such as, you know, General Electric, which we saw cause a bit of a stir, you know, credit spreads started to widen when we had headlines on GE and, you know, some of their leverage loans defaulting. So it's a problem I don't know necessarily that the Fed has their handle on just yet, but they, you know, they're moving into position, so to speak.
Okay. All right. So you wanted to talk about the VIX. So you're talking about we're in these new regimes. There's only a few months left of this year.
Correct.
Do you think the regime stays status quo through the end of the year before we get a new one?
By all measures and all the indicators that I look for, yes. Principally, you know, when we, you know, we're looking at a global slowdown, a global economic slowdown, even a domestic slowdown of sorts. And I try to focus on the rate of change because that's really the biggest headwind, you know, moving from one year to the next, from one regime to the next. And what we like to see is estimates coming down. As estimates come down, they present themselves as a lower bar for corporates, you know, basically to leap over. Combining that with the Fed easing cycle and financial conditions remain basically at cyclical lows. All of that is the recipe that we look for, a continuation in this, you know, lower volatility regime through the year end. Essentially, we should see tail risk abate. We should see hedge funds, institutional participation start to leverage up their risk exposure, especially in a low rate regime where you're also going to have end of year pension fund rebalancing, you know, commit, you know, more to the risk on, you know, portfolio than they are usually allocated. The risk-free premium there provided by the 10-year yield just isn't what it used to be. So their whole, you know, targeted strategy has to lean more heavily on the equity side than it usually does. So all of that together says that we should, you know, finish the year with a lower mode and median on the VIX itself. Looking here at VIX futures term structure, this is another one of the tools that I look at, which basically takes us to the year end. And right now you've got the VIX here at 14, and you have futures, whether it's the November or December, continuing to converge down. Now the slope of the curve is the most important to me. Even when I change the angle from narrow, this is about the steepest we've had. Sorry about that, it refreshes. But this is about the steepest we've had, whether I do narrow view or wide view, I would say in the last 6 months, which tells us that the VIX downside pressure is more prolific near term, according to the futures market. The futures market is going to converge over the cycle of 30 days onto the spot cash fixed price. So the shape of the curve is quite indicative of what the futures market, or implied volatility, is telling us. So, and we still haven't even hit the mode. A lot of people refer to the VIX and they go, oh, well, it's a mean reverting instrument. And this is a colloquialism that has just been accepted for the last 25 years, but it's a farce. It's not really true. The VIX is actually a mode reverting instrument. It spends the majority of its time in and around 12 and a half. So it'll spend a good deal of time around 13 and 12, a little bit less in 11. We can look at, the history here, and we can see the mode, historic mode is 1242. When we look at the chart here, you can see 9.05% here around the 13 level, 6.93% is the 12 level, so on and so forth. But everybody always refers to the mean 1928. It just doesn't spend a whole lot of time there at 1928. The majority of the time it spends around here. So I was listening in, Dale, on the conversation earlier on the VIX, and you'll hear it all the time on CNBC. Well, the VIX dropped below 16. It's getting cheap now. It's time to take out protection. That's where guys like me come in and go, there's another, insurance policy that's going to be voided pretty soon, because usually the VIX wants to and needs to basically achieve its mode at some point. So from 16 down to the 12s, there's a lot of premium you lose.
A lot. Well, options are like relationships, and 90% of them expire worthless. And you do have a lot of decay in a lot of the VIX products.
Exactly.
I actually have a question from Scott, and he says, so are you using the contango as a tell? If so, how are you using it?
So contango is a useful tool, but so far as guiding my trading participation, I short volatility through the leveraged VIX exchange traded products such as UVXY or TVIX or VXX. But my strategy is such that the most critical part of the strategy is allowing myself duration, giving myself or affording myself the greatest amount of duration to benefit from the inevitable. And the inevitable is that on any VIX spike of consequence, it has to eventually alleviate and come back down. So depending on how much exposure I have, that's how much duration I have to benefit from the inevitable. Now, using contango as a sub-tool within the strategy, I do, and I tend to have what I call the 5% rule, 5% contango rule. And the way that works is, and it's also predicated upon the shape of the curve. Now, when the curve is relatively flat, so right now, if we look at the curve, we see the front month contract distance to the back month contract is pretty steep at $2.70. And that's why the front of the curve looks as it does right now, and why I said earlier, we haven't had this much steepness at the front end of the curve in quite some time, especially this far out of expiration. We still have 28 days until the November futures contracts expire. So I like the shape of the curve primarily. I have duration to benefit from any short positions that I put on, even if the VIX spikes. But contango is above 5%. At 5%, I often, inform my traders in our premium member group, this is an ideal opportunity, as long as you have your, the right position size, to start a short volatility position. Goes up to 10% contango. Again, the 5% contango rule. For every 5%, the odds increasingly are in your favor for additional VIX exchange traded product decay, to ensue. So at 10%, we would add another position. at 15% another. So it is
So,
part of the guide,
mhm.
or I should say a subset of the tools that guide the overall strategy of shorting volatility with duration.
Shorting volatility and writing options have some similarities to me. And, I guess the key question is, writing options at times could be like picking up quarters on the sidewalk until the steamroller comes down the road. And we had a steamroller event in volatility products. When was it, Seth? 2 years ago?
February 5th, yeah, February 5th.
Okay, so how were you in a position and how did you manage risk when you had, an exogenous event like that?
So I've been doing this now for this will be the 9th year. So leading up to that, so here's my article, Short Volatility Strategies and a Word of Caution. So to your point, Dale, the volatility event, the biggest spike in volatility in a single day happened on February 5th, 2018. I wrote this article on November 19, 2017, basically warning folks about how overcrowded the trade was back then and some of the specific instruments within.
Okay, how do you know it's overcrowded? I mean, we have COT
Right.
for knowing things in certain markets. How do you know when positioning is extreme in VIX?
You can look at COT obviously from the commercial and the non-commercial side. You can look at
In
options
VIX?
chains. I'm sorry?
There's a COT report on VIX?
There's for non-commercial and commercial
Oh,
VIX futures
I see. Okay,
as well as options, VIX options itself.
okay.
But more importantly, you look at the open interest on the
If
individual ETPs.
strikes not in the options, the open interest on like TVIX and UVXY.
Correct.
Okay,
And going back to those dates in 2017 and through the year end, you could see the open interest was just extreme. In fact, I think it was back then that TVIX actually created more shares. They create shares every year.
yeah,
But
reverse
this was more of
splits.
a demand. Yeah, this was more of a demand side equation than it was anything else so far as balancing the fund. But in terms of, getting back to your question, how do you avoid situations like quote unquote Volmageddon? Well, that's where I fall back onto macroeconomics and just understanding the general rule of thumb that volatility moves in regimes. We went from a low volatility regime in 2017. We were looking at a Fed tightening cycle in 2018. More than likely, the greatest probability from an ultra low volatility regime is that you would have some mean reversion higher in the next calendar year. And that's exactly what happened. So I was able to avoid, any severe damage from that volatility event, mainly because I had the right macro outlook and understanding of the probabilities in 2018. Now,
So
after that,
you were flat
I
going
did have
into
some
it?
flatteners. Yes, I did have exposure. All of 2017, I had the 2X instrument, which was UVXY. At the tail end of the year, I took that down to a VXX, which is just a single leverage instrument. So it just doesn't move as much. You don't get as significant gyrations or risk with a VXX as opposed to UVXY or TVIX. And I had flatteners on as well, so that in the event of a more precipitous spike in volatility, I just wouldn't see the drawdown that most people would. So it's
Okay.
about the macro outlook. It's about understanding the nature of volatility, understanding positioning in the complex as a whole. You can avoid a lot of these, and that's what we teach people and educate folks on when at phenomgroup.com.
Do the technicals of the S&Ps come into play in your decision about VIX? Is there any subjectivity about what you see market structure wise that guides you for what kind of strategy you're going to execute in VIX products?
Minimal. As I mentioned, primarily it's a duration strategy to short volatility. But there are times that, we'll look at overextended, markets. We'll look at RSI and things of that nature related to the S&P 500 specifically to, kind of give us, maybe, the probabilities of a near-term market retracement and a possible uptick in volatility, to maybe reduce some exposure, take some profits, and reapply to those same positions at better prices.
Okay, what are you doing in here with this pretty comatose action in the VIX?
Yeah.
Same thing, duration,
So
trades.
at this time, I'm looking at the S&P 500 possibly achieving, a new high. And I'm in the process of, basically just taking profits. We have had a larger size position in UVXY for the last 4 or 5 months. And now with UVXY hitting all-time lows, with the S&P 500 on the verge of possibly achieving a new high, this is an ideal time where we would be reducing exposure, taking our profits, still keeping some exposure on, because you never know exactly when that next volatility spike will occur or how deep the decay in the VIX will be. But basically giving ourselves a little more cash to participate in the future and look at other instruments.
You ever do anything to take advantage of a price move to the upside in VIX?
It takes a good deal of market timing. You have to also have the right instrument, take the right strike in the option,
So
the right premium. Yeah, very rarely. At best, we have a strategy that we call long against the box. The boxes are greater or are bigger short position. And if we see a sustainable, multi-day probability for the VIX to head higher, we'll take out, so UVXY would be the short position. We'll take out a small hedge using a TVIX long. So we call that the long against the box strategy.
Okay. So what do you shoot? Go ahead.
An outright long on volatility? No, you got to time the entry and the exit pretty well.
Okay. So what do you shoot for on a per annum basis, return on investment or return on equity, using that strategy? What have you achieved over the last few years doing this?
So since it's became my primary strategy in 2012. So we've beaten the market every single year, average returns around just under 50%. This year, we're up 42% right now. I often post my brokerage account actually on my Twitter feed so people can check it out. And, but yeah, I mean, it's above average returns.
That's fantastic returns.
Thank you.
Yeah.
I trade a lot of retail stocks as well, as part of the, the collective, portfolio.
Stocks in the retail sector or just stocks?
Correct. I used to be a sell-side analyst covering the retail sector specifically and consumer packaged goods. So companies like Target, Bed Bath & Beyond, Walmart, Coca-Cola.
What kind of Christmas are we going to have, Seth?
It's going to depend. I mean, because as you probably, talk about quite often is what's the next tweet? As of right now, things look like they've de-escalated a good deal. And there's some quote unquote promissory notes out there for a phase 1 deal to be signed. However, if that doesn't come to fruition and it actually does a 180, so to speak, then I think you're going to have a sentiment shift once again in the market. And as we saw last year with a number of issues, you had the Fed hiking, you had the market downturn, New York property real estate downturn, and threatening of a government shutdown basically play out in the economy. And we saw it in December retail sales.
Yeah, what an ugly break that was in the market last December. I think I heard Elvis singing, "It's gonna be a blue, blue, blue Christmas."
Well, I'm not going to piggyback on that.
So everything really, do you think that the trade deal is bigger than the Fed?
No. I think the Fed has more tools in their bag than the media speculates upon. But we don't need anything creating a headwind. Let's put it that way. And I think you get two bad Christmases in a row, and the market doesn't necessarily recover from that in the out year. That's the bigger problem. It's okay, you get a one bad Christmas, which is what we had so far as total retail sales last year. But if you repeat that when it's already something that investors as well as consumers are concerned over, seeing how the recency bias plays a role in sentiment, then it's kind of like, how many times are you going to fool me? And that can be a self-fulfilling prophecy that plays out in the economy next year. And I don't think that is something that either the White House or the Fed wants to see happen. So I think
some guy that represents retail that they interview on CNBC all the time says that retailers are already cooked.
Cooked so far as inventory, or
cooked as far as what the higher prices they're going to have to pay because of the tariffs and margins.
Yeah, well, the front loading has been amazing. And I don't put it past the White House, and I don't put it past Larry Kudlow to understand, as long as they keep a certain level of fear out there at the corporate level, they can still achieve the consumption growth that fuels this economy. So, in other words, the dialogue, the tweets, they seem to, have this sustained elevation that provides sustained CEO sentiment, which is, pretty dire at this point if you look at the charts. And that basically fuels the front loading. But they can't pass that along to the consumer. So the consumer's numbers and the actual retail sales continue to look good throughout the year. And we just had a hiccup in September with the September 0.3 decline, 0.3% decline. But the rate of change here, when we look at the rate of change, because that's the most important thing. That's the biggest headwind we have in 2019. People look at the earnings, we're in an earnings recession. The reality is the comps were too high last year. You're not going to comp to that in the next year, but now we're setting up a low bar. When you look at PMIs and everything last year, all the front loading that happened before the July tariffs went into effect created these elevated PMIs that you just can't get back to. Mm-hmm. So it's this, and then you got to work off all that inventory as well over the next 6 months. And I see a lot of that play out in the retailers. I used to work for Target. I was an executive at Target for some 8-9 years. I visited, we used to travel to China, Cambodia, Vietnam, all of the Asia Pacific countries, looking for something that wasn't and could scale, a production line that wasn't in China. The problem with doing that is, and we signed a deal with this company in Thailand. This is Target. We went to it was a textile, a private label that Target was looking to move away from China. And we went to Thailand. We found somebody that could do it. So when we finally get, the purchase invoice and all of that good stuff, and the contracts were just about to be signed, what do we find out? We found out that this was a Chinese JV. It was a joint venture owned by China. So you can't quite get away from that situation. But the other alternative is for retailers to basically, as you said, cook and front load, buy all the inventory, get all the product here before the tariffs go into place, to avoid, an increase in the tariffs, and still not have to forcibly pass along, the increased costs to the consumer. Now, what we are seeing, though, is certain costs are being passed through, but it's on the retailers follow an 80-20 rule. 80% of their sales come from 20% of their goods. So where they get the greatest volume, and they know they have to have items like toilet paper, that's where the prices go up. They can afford to, basically pass it along on toilet paper. They can't afford to pass it along on this brochure, this decorative pillow that doesn't have the same volume.
Interesting. Great explanations. And really appreciate you being here, Seth. What's the best way for people to get in touch with you, follow you, your Twitter handle, your website?
Yeah, so here's our website, phenomgroup.com, spelled with an M. It's kind of an acronym for financials and phenomenal, because we tend to, generate phenomenal returns for all of our members. We have a trading room, we have trade alerts. Most important is our weekly research reports, which guides us every single Sunday. It comes out every single Sunday with our expectations and our broad-based analysis. Everything from all things related to the S&P technicals, all things related to the economic data that came out in the week and what we can expect in the week ahead, fund flows, earnings outlook, and then, of course, investor takeaways, our thoughts about the compilation of the research that we've, taken apart throughout the trading week.
Well, thank you, my trading warrior brother, for coming back and edifying us about VIX and how you approach it. And yeah, the choo-choo train's coming, and hope that the caboose is full of cash for you
Thank
and
you,
your
sir.
subscribers, and that you have a great finish to the year, and really appreciate your knowledge and your expertise in something that I have a hard time wrapping my head around. VIX products and crypto I could put in the same category. So anyway, Seth, thank you very much for being with us today. And, consider
Thank
you
you.
my trading warrior brother. I tweet your stuff, and I'm glad our paths crossed on Twitter.
Me as well. Thank you, and have a great end of the year, and God bless.
Thank you. Everyone, that's Seth Golden, and you could follow him. Seth, will you want to give your Twitter handle again? I believe it's Seth _ CL.
Seth CL, capital CL, at Seth CL.
Okay, there's no underscore before
No,
CL.
sir.
Seth CL.
Yes, sir.
For a cool looking guy. All right. So have a great one, Seth. Thanks
You
again,
too.
buddy.
Thank you. Bye-bye.
All right, everyone. So that's a wrap for Turnaround Tuesday. Euro pound's trying to make a move. We'll see everyone tomorrow. Good hunting the rest of the day, and don't just count your pips, count your blessings. And Gregorios, if you're still here, oh, you're welcome, Brock. Thank you. Barry, I think he said 50% return. And Gregorio, if you're here and you want to talk about what's happening in the funds market, please get a hold of me either through ForexAnalytix or through Twitter, and we'll set it up. And that's a wrap, everyone. Good hunting. Adios.